Another day, another market rally on Wall Street. Finished up over 1% on the S&P 500. The small caps really shined here today. We did hear some buzz about the Federal Reserve today firing their so-called bazooka. And part of that emergency stimulus suggested that they'll be buying junk bonds, which is something that you typically do not find. And so this gives a sign to the market that this is a Fed that is willing to prop up the market at all costs. And of course, market participants have cheered that news thus far. We'll see where it takes us, but what we do know is factually this week was the strongest week in the stock market since the 1970s. Now, obviously, context is important here, and we're still down significantly from the highs that we placed just a couple of months ago. Nonetheless, we're at least trending in the right direction here. So we'll take a look at all of that, see what it means for our posture. We'll then take a look at a trade example from an area that I've been talking about quite a bit in these presentations here recently, and I do want to take some action on it here tonight. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 9th, 2020. First of all, if you're new, welcome aboard. Remember to go over to our YouTube channel and click subscribe. While you're over there, check out our description area and sign up for our email distribution list, and that way you can be notified whenever we issue these videos, and also gives you a heads up on any stocks that might be giving you an overbought or oversold cluster signal in the S&P 500. In addition to that, we're heavy users of Twitter. I would encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that support us on Twitter. That is our main social network that we engage with our users in, and you guys have done a fantastic job for us, and we really do appreciate that. So anytime you want to give us a like or a retweet with these market outlook related videos, it gives us a heads up that you want to see them continued as often as possible. Now, of course, tomorrow is Good Friday. Here in the United States, we won't have the stock market open, and therefore there's no video tomorrow, but we'll get back in the saddle early next week. So just wanted to give you a friendly housekeeping note there. Most of you are aware of that, but just making sure that you're not wondering if you're missing out on a video on Friday. This week, we'll end it with this video here tonight. Lastly, we do have a presence on Facebook as well. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's jump into our charts here. And as has been the case for the last couple of months, more often than not, I start with this chart 6D just to give us a sense of some of the more extreme moves we've been witnessing here recently. Anytime we have more than a 1% move, I like to pull this graph up just to kind of give you a sense of things. And of course, during the fall and into the winter, we really didn't have much of anything to report in terms of significant movements up or down 1%. Of course, everything changed here with the coronavirus in the last month or two. Now, where we landed today was just a little bit above this first blue line here. This blue horizontal line represents a 1% up move. The blue horizontal line on the downside would, of course, be a 1% down move. So this is where we ended today. In the grand scheme of things, considering how much we've been moving recently, this was actually considered one of the more quiet days that we've had when you compare some of these just truly aggressive moves, you know, down 9%, up 9%. These are some truly historic markets we've been kind of struggling through for the last couple of months. So today actually would have been considered a quiet day, but nonetheless was up more than 1%. You can see we continued that trajectory that we've been on since hitting those lows back here on the 23rd of March, and have actually risen more than 20%. It's like 24% off the lows here. So really kind of an impressive move there, and a stronger response than I was expecting. Although at this point, I'm still not ruling out the possibility of some sort of a retest of the prior lows. If that doesn't happen, I'll be happy about that. But at the same time, I do recognize that most market breakdowns throughout history do not respond quite as quickly to the upside as what seems to be the case right now. It seems like we're just right back on the path to growth again, yet we look around us and we see that we're still all self-isolating, and most of the businesses that we once gave money to may have their boards or their doors boarded up right now. So it feels a little bit strange to see the world around us and then look at the stock market going up nearly every single day here in the last couple of weeks. So we'll see where that ends. Obviously, there is something to the idea that the stock market is forward-looking, and perhaps this is the stock market's way of letting everyone know that here in the coming months we will get past this coronavirus and business will largely get back on track. But my fear is that earnings are going to come down significantly. And at this point, I'm not sure that I trust that the stock market has priced that in appropriately quite yet. So we'll see. Regardless of what type of market we're in, we try to come to you with ideas and opportunities as we see them. So anyway, one other thing I should point out before I move to the next chart here is the VIX down at the bottom. You can kind of use this purple line here as an acknowledgement of where the VIX is. VIX is at about 42 or 41 right now. Remember that we topped out on the VIX here above 80, and so we've already given back about half of that move, but just keep in mind that 41 is still considered historically high, particularly considering where we came from. In the last year, the highest we had come on the VIX was probably about 24, 25 back here in early August. So even with this significant rally off of the lows, more than 20%, as I mentioned before, the VIX is still at a very elevated level, all things considered. So there's still a lot of professional traders out there that view risk in the system, and we have to recognize that there is the possibility of an equally sharp negative reaction to this big move that we've had here in the recent days. So we'll keep our eye on that and report back to you what we see as always. Let's go ahead and take a look at our next chart setup. This will be 4B, and this of course is kind of the reason behind the video. We look at the market outlook video, or the market forecast indicator in the market outlook video to kind of describe what our posture may or may not be. And as most of you are aware, if you've been watching the video over the years, the green line is the default kind of posture setting mechanism within the market forecast technical indicator that you can find over on the Thinkorswim platform. When the green line is trending higher between 20 and 80, we consider that to be a bullish posture. And that is where we stand now. Now you'll remember that on Tuesday when I was last with you, we had 3 out of the 4 charts with a bullish posture. We had the S&P 500, the Dow Jones, and the NASDAQ. But the Russell 2000 was kind of the odd man out. You'll notice that in the last 2 days since I was last with you, we've had really strong performance out of the small caps. In fact, we closed near the highs of the session both of those days, and they weren't small days by any measure. You can see here Russell 2000 was up 4.6% today. It's a pretty aggressive move. So that's a very positive sign, because that was one of those little flies in the ointment that kind of seemed a little mysterious as to why the markets were going up, but the small caps didn't want to seem to participate. Now we're starting to see them participate. That's a sign for the bulls, to kind of add to their resume of why this market is about ready to rebuild and go back to the highs of where we were before. Again, I'm a bit skeptical myself, but I also acknowledge where we are in the charts, and there's more constructive behavior on the charts, and that's a positive sign, and I'm thankful for that personally, and I hope it does continue. However, we do have to recognize that the path of least resistance on all of these charts continues to be to the downside if you're using that 30-day moving average as kind of your proxy for that. The good news is you can see that the moving averages are all yellow at this point, meaning that price is above the rising moving averages in each of those cases. So not only did the Russell 2000 give us a weekly bullish posture, it also crossed up and above the downtrending 30-day moving average. So remember, the next step would be, if you're trying to make the case of why this might be a bullish market going forward, would be to eventually have that moving average start flattening first and then eventually curling higher. Now remember, by its very nature, moving averages are lagging, which is the whole point of them. In this case, we're looking back 30 days, 30 trading days, and then averaging out those closing prices. So basically, the 30th day way back gets lopped off and the most recent day gets added, and that process continues on as time goes on. So if these indices can stay above those moving averages, what will eventually happen is the moving averages will start flattening out here. Right now they're still going down, but at some point they will start flattening out, and then hopefully a few days after that they'll start rising. And at that point your hope is that the moving averages are then used as kind of bounces or launch pads, similar to what we had before. Now this is highly skewed because of the extreme move that we had in the month of March, but you can kind of see like back here on the S&P 500 in late January, markets came down and then bounced off of that. And you like to see that if you're looking for strongly trending markets. We'll see if that happens or not. Obviously, there's a lot of unknowns out there. And, the good news is we're starting to see more positive news in regards to the coronavirus. On the bad side, New York is still being hit. In fact, they were saying here today that more lives have been lost now due to the coronavirus in New York than what we saw on 9/11, just to put that into perspective there. So we're certainly not out of the woods, but a lot of the trends that we're seeing have become a little bit more positive. We'll see if that eventually kind of advances to other hot spots in the United States, whether it's Chicago or New Orleans or Miami or what have you. But right now, kind of the what we've been seeing is that New York has been the hardest hit, and other cities really haven't kind of elevated to its extreme levels for whatever reason. Maybe it's just the fact that it's such a crowded space there, in New York City and Manhattan, and maybe that is added to the strain of the virus on that particular city, and we won't see as extreme consequences in other cities. We don't know yet, but right now the market is taking it a bit more in stride compared to where we were in mid-March, where there was, outright pandemonium and panic in the markets, where you were, selling first and asking questions later. It seems like we have kind of the reverse of that now, where people are willing to kind of absorb the data, the statistics, and see what that means for them and their investments. And right now, with the path of higher highs and higher lows, we're seeing more promise there that the market is willing to give the numbers the benefit of the doubt. So we'll see. Like I said, we've got a long summer in front of us, and right now we're feeling a little bit better about our investments than we might have a month ago, but it does not mean that we're out of the woods yet. There's still a lot of strain on our economy, and we don't know when we're going to be fully back open to business yet. And of course, profits drive stocks over the long haul, and right now profits are not being made. So we'll keep our eye on the story and share our thoughts with you as time goes on. But right now, just from a technical analysis perspective, we can say that the postures on all four of our charts here are now bullish. Now they're just weakly bullish, they're not strongly bullish, but we're heading in the right direction. And we're not that far away, quite frankly. We might be saying by mid next week that we do have a strongly bullish posture, because as most of you are aware, once the green line goes above 50 and continues rising, that's when we start switching over to a strongly bullish posture. Remember, the background colors of the charts will turn to that darker shade of green when that happens. But right now, the NASDAQ composite is at 45 and rising. So we're not that far away from 50 right now, or the indicator's midpoint here. You can see that that green line down below nearly touching 50 here. So that could happen as early as next week on a few of these. We'll keep our eye on that. We have to remember that with this holiday weekend we've got coming up, we've got not just 2 days of news that comes in without markets being priced, but we actually have 3 now. So generally that's not a big issue, but when we're dealing with a health pandemic like we are right now, where generally speaking the numbers that we hear are bad, that can sometimes scare a few market participants there as well. So we'll keep our eye on the open on Monday. Fortunately, the last few Mondays have actually not been that bad at all, and so hopefully we're kind of past that point where everybody was fearful of the Monday open like we were back in March. But we'll see. Right now we do have weekly bullish postures on all 4 of our major indices, and most of the indices were up approximately 1% today to cap off an extremely strong week. Checking out a longer term view now, with this being kind of the last video of the week, I think it makes sense for me to take a look at the 1040 crossover method. I don't do that in every video, but considering this is the end of the weekly candle here on a rare Thursday when I do these videos, let's have that conversation. So as it stands here, not a whole lot of differences to report, but there is one thing that is catching my eye. So the postures are still the death crosses, the bearish crossovers. But there is one thing that is catching my eye that you might just want to put as a feather in your hat just to kind of think about a little bit later in case it becomes a little bit more important as time goes on. And that is that on the S&P 500 and the NASDAQ composite, you'll notice that we had a slight curl up in that orange line. Now, for those of you that are not as familiar with this chart setup, this is chart 4C. This is our 1040 crossover method chart, and this is a weekly candle chart that goes back 3 years in length. And that orange line matches up with the orange label that you see up at the top here. So this is going to be our 10-week moving average. And then the blue line is going to be our 40-week moving average. The orange line will be more sensitive because it tracks the smaller amount of data, so it can move around a little bit more quickly than the slower moving blue line that tracks more data. So you can see that we've had a little bit of a positive upstart right there in that orange line. I know it's kind of hard to see there with the naked eye, but remember you can also kind of see it down below when you're looking at this PPO that's directly below the price graph. There's a slight tick higher there in that purple line down below because it's recognizing the slight pinching of the blue and the orange lines there. And the reason for that is because the orange line ticked higher just slightly this week. So the blue line continues to fall, but because the orange line ticked just a slightly higher, there's a little bit of a pinching of those lines. And remember, if we ever do have a bullish crossover or a golden cross, then we will need those lines to start pinching towards one another. So we do have the first little sign of that, at least with the S&P 500 and with the NASDAQ composite. We don't have that yet over here on the Russell 2000 or the Dow Jones Industrial Average. So, you know, it's not necessarily a grand slam data or statistic there for you, but at least there's tiny little signs of hope. And, you know, this time of year we see that all around us. I do like the fact that, you know, spring is happening around us regardless of what's happening in the stock market, and the trees and the flowers are blooming, and you know the birds are coming back, and you know we've got Easter over the weekend, and there'll be you know backyard Easter egg hunts, and you know it's just a happier time of year. So consider that a small green shoot that we're starting to see there, even on this longer term chart. So we don't have enough evidence to suggest that we're bullish there on this particular chart setup, but at least there's a tiny little glimmer of hope at the end of the tunnel there. All right, let's go ahead and take a look at another chart. Let's start doing some 12 grid analysis over here, starting with chart 5A. These will be our asset class 12 grids. And the background colors of the charts will tell you whether we have a bullish posture or a bearish posture. And then the shadings will tell you whether those postures are weak or strong. And so we actually have all four of those shading possibilities on the charts right here in front of us. So as an example, down below here, you'll see that GLD, which is an ETF that tracks the price of gold, has that deep shade of green that we're dealing with, meaning that this has a strongly bullish posture according to the intermediate line on the market forecast. Here you can see the line is actually at 84 and rising. Remember, above 80, it doesn't matter if it's rising or falling. That's the upper reversal zone. It's always considered strongly bullish up there. But in this particular case, it's at 84 and continues to rise. This is an area that I've been talking about a lot on our videos here in the last several weeks. First of all, because of the strange move lower that it had at the end of March, and then the equally as quick rebound here. But you can see here, this was a very strong move out of GLD today. We were up about 2.6% there. And not only that, but we actually had the highest close for GLD in the last 3 months here. Now, on an intraday basis, there were a couple of candles right here in early March that were slightly higher than where we got on an intraday basis today. But on a closing price basis, this was actually a multi-month closing high that we set on GLD. So money continues to drift into gold. As I've been mentioning in recent weeks, it's my thought that this was a head fake down below here where people were using gold as a source of funds because they were getting margin calls on their other holdings, and this should not have happened. Now it did, but maybe it didn't deserve to. Point is, it rebounded equally as quick, and while the stock market itself, here's SPY up here, isn't anywhere remotely close to its multi-month highs despite the really strong rally off the bottom, GLD is. We're right back up there. We're right back into strongly bullish trends on GLD. And to me, that makes sense. What didn't make sense was it falling out of bed in the first place. This makes sense to me because we're in helicopter money land right now, right? There's money being poured down upon, businesses, being poured down on Main Street, being poured down apparently on junk bond markets, which is something that is fairly rare to see. So this is a environment that is possibly heading into more of an inflationary market. Now, we've said that at times in the past, and it's never really happened to a big degree, but when we're talking about a stimulus program that is multi-trillion dollars like we have here in recent weeks, it is possible that we get into more of an inflationary environment. And one of the beneficiaries of that inflationary environment might very well be gold. So that's an area I want to keep my eye on. You'll also see that these other charts that I mentioned over here with the SPY, it has that lighter shade of green. That's telling us that we do have a bullish posture, but it's a weekly bullish posture. And you can see up here, whether you're looking at US stocks, developed foreign stocks, or emerging foreign stocks, they're all kind of in the same boat with that weekly bullish posture. I would say that it looks to me right now like the emerging markets are the weakest. Not only are they down the most in the last 3 months, you can see they're down 22%, whereas the developed foreign markets are only down 20%, US stocks down about 15%. But you'll also see the positioning of the candle. This is the only one where we're still below a falling moving average. Notice the tip of that moving average on developed foreign stocks is yellow, and it's also yellow on US stocks. But over here, the tip on the foreign stocks is still red, telling us that price didn't quite close above that moving average. So they are the laggards around the world right now in the emerging market space, despite China doing its best effort. You guys will recall that China was actually one of the leadership markets here a couple of weeks ago. While we were grappling with the coronavirus, they were kind of getting beyond that, and some of their economy has already started back up. So remember that EEM is not just China, it's a whole bunch of emerging markets out there. And, I don't know how much to read into that, but maybe it's an infrastructure issue or what have you. So there's also the possibility of this coronavirus heading down towards South America is one of the projections later on in the spring and summer. And so maybe there's a little element of that kind of embedded within EEM right now as well, kind of the idea that there's a little bit of tough times in front of some of those emerging markets down south. Anyway, the other two colors or shadings that you see on the board are these pinker shadings. So let's talk about the US dollar. US dollar actually fell here today, pretty significant amount. It was down about 0.74%. Remember, this is one of the most important currencies on the planet, probably would be considered the most important currency. And so it doesn't move around with huge percentages usually, although we had a couple of those extremely wild days right there and right there. But normally a 0.7% down day for the US dollar is actually a pretty extreme move. And it was enough to push that posture back to weekly bearish. That's that lighter pink background color that you see there. However, we did manage to close slightly above the rising moving average. We kind of have two opposing thoughts there. On the posture setting mechanism, slightly bearish. On the path of least resistance, slightly bullish, with the thought that perhaps we could get a little bit of a bounce off of that level, similar to how we did it back here in late March. So we won't know about that until early next week, but it is setting up for that possibility, so be aware of that. However, if it does break down below the moving average, in addition to its weekly bearish posture that it's now showing us, remember that that can help support gold prices as well. Gold tends to go up when the US dollar goes down more times than not. So not only is it kind of viewed as a safety asset and an asset that could benefit if we get into a more inflationary environment, as I mentioned before, but it's also an asset that could benefit if the US dollar were to start trending lower. So we'll keep our eye on that story. Oil was down today. Boy, that thing just cannot get out of its own way. There was some optimism here a week or so ago that, maybe production cuts out of Saudi Arabia, Russia, what have you, might start propping up the price of a barrel of oil, but we just haven't seen that. That's fizzling right now. And the enthusiasm over that potential deal is just going by the wayside. We're awash in oil right now, and we've got so much oil we don't know what to do with it, quite frankly. There's lots of tankers off of the coasts of many countries right now that are just filled to the brim with oil because they can't sell it. So it's a difficult situation. It's going to take some time to kind of work off those inventories, and it's particularly hard considering we're all cooped up in our houses right now, not really driving around as much as we typically would. So that's the strongly bearish posture right there with crude oil. Let's go ahead and take a look at another set of 12 grids here. Let's do the U.S. sectors and see how things ended up for the week. Good news is we have a clean sweep to end the week. In other words, all of our charts are green. Now remember, these are sectors dedicated exclusively to large cap U.S. stocks. So you might see some slight differences if you were looking at other areas around the world with different sectors, or even looking at small cap stocks that are in various sectors. But at least from a large cap U.S. perspective, we do have bullish postures across the board. We actually have strongly bullish postures on healthcare and staples. And remember, for those of you that keep track of my sector selector tool that I usually put out on Fridays, those have been two of the top three, along with technology, for basically the last month. So that makes sense that those are still the ones that are kind of leading the way and giving you a little bit of separation between where they're trading and the moving averages themselves. Now, it's true, the moving averages are still falling, so we've got work to do, but there is some separation. If you're to look at, healthcare as an example, we've got, some decent separation from where we're trading right now and where the moving average itself is. And if you compare that to something else like, how about industrials, you can see that we're basically just touching the moving average right now. There's not a lot of separation there. So anyway, those are our two stronger areas right now, is healthcare and staples. And of course, that doesn't really give us the warm and fuzzy feelings about being a risk-on marketplace that's ripping to the upside. A lot of times when you see healthcare and staples leading the way, that's more of a defensive posturing by the market itself. So that's one thing that maybe the bears have in their favor right now, is that you're just not seeing really aggressive moves from some of those other more cyclical sectors at this point. But the good news is we do have bullish postures across the board. The only sector that was down today was energy. Of course, that makes sense with oil prices falling yet again, but XLE was down 0.91% today. So while it has a weekly bullish posture, its performance today was slightly negative. All of the other charts were positive here today, so a pretty solid rally across the board. Good breadth across the board. Even a few stocks hitting new 52-week highs today, which we haven't really seen that a whole lot out there. But there were some data center REITs and some gold stocks and things like that were hitting new highs. And that's a good segue for my next conversation. Let me go ahead and let's start talking about our trade application example today. I'm just going to bring up chart 3A for this purpose. And I kind of talked about it a little bit already. Wanted to talk about gold. Gold is continuing to make a very nice move. We already have a position on GLD. In fact, we have two positions on GLD. We have a longer-term, long-term holding of 530 shares, which we've done very well on over time. But we also have this bull-put spread that we put on more recently that continues to work for us there as well. So I didn't want to put on a third bullish trade on GLD So I thought I would start fishing around in some of the gold miners. And we actually saw some really robust activity out of some of the gold mining stocks here today. Newmont Mining is the only gold mining stock in the S&P 500, and you can see that it had just an epic day. It was up 13%. Now, it was so strong that it actually produced an overbought cluster signal. We probably don't have a whole lot of those here these days, but this is one of the few that actually ended that way here today. So Newmont just took off like a rocket ship here today. Another one in kind of the mega caps, or not the mega cap, but the large cap space, because there's not really any mega cap gold companies out there after the damage that's been done to that industry over the years. But Newmont's about the biggest of them. And then another one that's pretty big as well as Barrick Gold. This one had a merger in the last year or two and changed its ticker symbol. Some of you that have been around long enough will remember that the old ticker symbol for Barrick was ABX. This is now GOLD. So a little bit easier for people to remember. But you can see that this one had a very nice day as well. It was up 10% here today. And while it wasn't quite as strong as Newmont, because it's not breaking new highs, we're on the cusp of it. So some of you that might be looking to play kind of a breakout type of a play might want to keep your eye on GOLD and see if it can get up and above 22.57 early next week. It looks like the odds of that are pretty strong. But it wasn't just a large cap gold story. We saw some small cap miners making big moves here today as well. One of them that some of you might recognize that has a lot of property up in Alaska is NovaGold. NovaGold has been just exploding higher here recently. Take a look at this. This stock was at $4.65 here in the middle of March, literally less than 1 month ago, and it has already gone up more than 100% in that time. Now, in doing so, it basically just made up for all that it lost prior to that. But remember, again, the stock market itself isn't anywhere near being able to make that particular claim. We're still well below our multi-month highs on the general stock market. So this particular company completely fell out of bed, but then completely reversed that and actually hit a new high here today at $10.24. This is a very small company. There are a number of those smaller companies that were making some pretty aggressive moves today, which had me wondering, okay, well, what's GDXJ doing? GDXJ is an ETF that tracks junior gold miners. So junior gold miners ETF. This is from Van Eck Vectors. And it's a little bit lesser known than its kind of cousin, which is GDX. GDX is the senior gold miners. GDXJ is the junior gold miners. Both of them had strong rallies here today. GDXJ did not rally quite as much as the seniors, and so it might be a little bit more of a catch-up play, right? If we can get more of those smaller cap gold companies like NovaGold to completely reverse the washout they had in mid-March, then this GDXJ stands a pretty decent chance of meandering back up here to maybe the mid-40s again before it's all said and done. So that could be one that offers us an opportunity, because many of the small cap gold mining companies are not very liquid when it comes to their options market. When you cobble a bunch of them together and throw them into an ETF, that helps us at least play the theme and be able to do it through the options world. So what I wanted to do in this particular case is do a bullish trade, but do one where we're taking advantage of the somewhat high implied volatility right now and do what's known as a bull put spread. So if I were to come back on over here to the trade tab, you can see the spread that I've got pulled up down below. What I've done is I've come over here to the May monthly contracts with 36 days left until expiration, and I'm looking to sell the $30 strike, and I'm looking to buy the $29 strike. So that's a $1 wide spread right there. Remember, with commissions being fairly cheap these days, in some cases next to nothing, even doing $1 wide spreads can be a little bit more useful than they were in yesteryear when we had to think about commissions a little bit more. But for some of you, maybe you explore the $2 wide or what have you, or adjust your strikes. But for my purposes here, I'm going to try to do this one. Now, again, I'm going to stress try because the market's not open tomorrow and the market's not open the day after that or the day after that. And so by the time we get back into, the market on Monday, it's entirely possible that gold is, spiking yet again when the futures market opens on Sunday night. So we have to be mindful of that. There's a fairly decent chance this trade does not get filled. But I think it's worth at least exploring because it gives us an opportunity to have a little bit of wiggle room to be wrong, right? We don't necessarily need the gold miners to completely explode higher for us to make money on this trade. Let's face it, there's already been a pretty aggressive move, right? Even here, we went down all the way to 19 and have now found ourselves at around 36. So while it's not quite a double, it's getting close even for the entire ETF, right? So there's been a big move there, and there is the risk that if we're finally identifying it now, that this move will fail because there is a fairly significant amount of percentage gain that's already been had in this particular move. So while buying a call or buying shares outright isn't necessarily the worst idea in the world, you do have to kind of recognize that we've already had a really significant move and there's a possibility that that could fizzle out. So by doing a bull put spread, it gives us a little bit of wiggle room where we don't have to be perfect with our timing on it. And by selling the $30 strike, effectively what we're saying is we want this stock to stay above $30. If it can do that, we can make money on the trade. And when we're making 24 cents on a $1 wide spread, we're making about a 30% return on risk. So it's a decent amount enough of a reward to at least consider taking the trade right there. But it also gives us that luxury that if we're wrong on our timing and this thing fails as soon as we get into it, we've got $5 worth of wiggle room between where it's at 35 right now and where we start suffering a little bit of pain below $30. So is it the most exciting play where you can make spectacular profits to the upside? No, it's not. But is it a useful trade where you can make appropriate profits and a 30% return on risk and also kind of recognize that we're in a pretty significant trend here that is being driven by the underlying commodity that is at new multi-month closing highs here today. So this would be a little bit of a catch-up play, I guess you could say, from that perspective. So let me go ahead and place that trade by clicking confirm and send and shipping that into the market. And we'll see in this case if we can get filled on Monday morning with this particular trade, since the market is not open tomorrow with it being Good Friday. And with that, I want to thank you for checking out the video. Happy holiday to all of you, wherever you're at around the globe. I know we have a lot of international viewers of this video as well here on YouTube. So I hope you all enjoy your holidays. I know these have been tougher times for a lot of us all around the globe dealing with this pandemic. And so let's remember what we are thankful for and try to look for those green shoots around us, and hopefully you enjoy some nice spring weather wherever you're at as well. If you got value out of tonight's video, as always, we'd appreciate it if you go on over to Twitter and click like for us over there. And David will be back with you on Monday. So until then, best of success with your trades and your investments. Goodbye for now.